Something unprecedented has just happened in the silver market, and if you are not paying attention right now, you are about to miss one of the most asymmetric wealth events in modern financial history. On December 18th, 2025, JP Morgan Chase did something that should instantly make every serious investor stop and look twice. They didn't issue a research note. They didn't adjust the forecast. They didn't hedge with options or shuffle paper exposure. They executed a direct purchase of 12.4 million ounces of physical silver at $71.80 per ounce. Not futures, not derivatives, not paper claims. Physical metal, bars that must be mined, refined, transported, insured, and delivered. This matters more than most people realize. JP Morgan is not a reactionary institution. It does not chase headlines. It does not panic buy assets at the top of a market. For over a decade, the same bank was widely associated with suppressing silver prices through paper mechanisms, benefiting from lower prices while controlling price discovery. That was the playbook. And they followed it with discipline, until now. Because when the most powerful player in the silver market suddenly abandons paper and starts paying premium prices for real metal, something fundamental has changed. Institutions like JP Morgan don't move first out of fear. They move first because they see risk before the rest of the market does. This wasn't a bet on upside. This was a move to avoid something worse. And the most important question isn't what they bought. It's why they were willing to pay nearly $72 an ounce for metal they were selling at less than half that price just months ago. Whatever triggered this decision is already in motion. And it's unfolding right now. What made that move even more alarming was what happened next. JP Morgan wasn't alone. And once you see who followed them, the story stops being about a single bank and starts becoming systemic. Just 2 days later, HSBC stepped in, quietly, decisively. They purchased 18.3 million ounces of physical silver at $72.15 per ounce. Again, not paper exposure, not futures, real metal. Then, on December 23rd, 2025, Bank of America joined in, securing 16.7 million ounces at $72.40 per ounce. 3 of the largest financial institutions on the planet, all buying physical silver, all within weeks of each other, all at prices they spent years making sure the market would never see. This was not coincidence, and it was not diversification. According to the Commodity Futures Trading Commission's Commitment of Traders report, released on December 20th, 2025, these 3 banks collectively acquired 44 million ounces of physical silver in just 6 weeks. 6 weeks. Let that sink in. These are institutions that move slowly, plan carefully, and avoid drawing attention. Yet here they were, draining the physical market in plain sight. To understand the scale, you have to translate ounces into reality. 47.4 million ounces is enough silver to build approximately 1.3 million electric vehicles, or to manufacture around 950,000 solar panels. This isn't an abstract number. This is industrial scale metal being pulled off the market by banks that were never supposed to need it. And here's where the divide becomes clear. They see something forming beneath the surface. They have access to delivery schedules, inventory data, and contractual obligations most people never see. We only get the headlines after the move is already made. Banks do not reverse decades-long strategies unless the risk of staying put becomes greater than the cost of acting. Paying over $72 an ounce wasn't about upside. It was about urgency. It was about securing metal before someone else demanded it first. This wasn't one bank making a bold call. This was the financial system quietly changing its behavior. And when institutions that helped design the rules suddenly stop trusting the game, the next question isn't what they're buying. It's what they're trying to get ahead of. What made this buying spree truly disturbing wasn't just the volume. It was where the silver was coming from. This metal wasn't sitting conveniently on a loading dock in New York. It was being pulled out of London vaults, slowly, expensively, with the friction. These banks were draining physical silver from one of the last major storage hubs on the planet, paying premium logistics costs, accepting delivery delays, and absorbing risks they would normally avoid at all costs. Banks hate friction, they hate delays, they hate inefficiency, yet they were choosing all 3, and they were doing it at prices 8% higher than where they were selling silver just 8 months earlier. That detail alone should make you uncomfortable. These are the same institutions that spent years ensuring silver stayed cheap. the same players that benefited from suppressed prices. Now, they were willingly paying multiples of those levels, not for leverage, not for exposure, but for metal that had to be physically moved across oceans. This wasn't smart trading. This was forced behavior, because when institutions abandon efficiency and willingly overpay, it's usually because the alternative is worse, much worse. Every ounce pulled out of London tightened the system. Every shipment reduced flexibility. Every bar removed increased pressure somewhere else. And the banks knew it. They weren't just buying silver. They were racing against time. Here's the part most people miss. London was always the pressure valve. When markets tightened elsewhere, metal flowed from London to keep the system functioning. That flow made shortages invisible. It kept the illusion alive. But now, the metal wasn't flowing smoothly. It was being pulled aggressively, under stress. That tells you the buffer was failing. And when buffers fail, problems stop being theoretical. This is where frustration turns into clarity. We're told markets are liquid. We're told supply chains are resilient. We're told price moves are just volatility. But behind the scenes, the institutions closest to the system were acting like people who no longer trusted the exits. They weren't preparing for upside. They were preparing for exposure. So ask the obvious question, the one nobody on financial television wants to say out loud. Why would the most powerful banks on earth accept higher prices, higher costs, and slower delivery for silver unless they knew something the rest of the market hadn't been told yet? Because the real story doesn't start in London. It starts with what happens when there isn't enough metal left to move. Once the metal leaves London, there is only one place left that truly matters. And this is where the story stops being abstract and becomes brutally mathematical. The answer is COMEX. As of December 24th, 2025, COMEX reported just 34.2 million ounces of registered silver inventory. Not total inventory, not paper claims, registered inventory. The metal that is actually available to be delivered against futures contracts. The metal that exists for settlement when someone says, I want the silver. Now compare that to where things stood in January 2021. Back then, COMEX held 110 million ounces of registered silver. Read that again. In 4 years, 69% of deliverable silver is gone. Not reclassified, not temporarily unavailable, gone. This is the part they don't emphasize. Headlines talk about prices, analysts talk about sentiment, but the real signal is inventory. Because inventory doesn't lie. It can't be massaged with language. It either exists or it doesn't. And right now, it doesn't. What makes this worse is how quietly it happened. No alarms, no emergency press conferences, just a steady drain, month after month, as metal left the system and never came back. The number shrank while most people weren't looking. That's not an accident. COMEX was designed to function smoothly as long as demand for physical delivery stayed low. It assumes most players settle in cash. It assumes trust. It assumes compliance. But that entire structure rests on one fragile assumption that the metal is there if it's ever needed. 34.2 million ounces is not a buffer. It's a warning. Because once registered inventory falls below a certain level, the system stops being flexible. Every contract matters. Every delivery request tightens the noose. And every large buyer suddenly becomes a threat to everyone else still holding paper. This is where frustration turns into anger. We're told the system is stable. We're told futures markets provide liquidity, but liquidity without metal is just a promise, and promises break when pressure shows up. Banks saw this number before most people did. They didn't debate it, they didn't wait for commentary, they acted. Because when registered inventory collapses this fast, it doesn't signal a problem coming someday. It signals one that's already here. And once you understand that, the next question becomes unavoidable. What happens when more silver is promised than physically exists to deliver? Once you see the inventory number, the rest stops being opinion. It becomes math. Cold, unforgiving, impossible to argue with. Here's what the system is facing. Within the next 97 days, total delivery obligations exceed 89 million ounces of silver. Not projections, not estimates. Contractual obligations already written into the system, metal that must be delivered to someone who has the legal right to demand it. Now place that number next to reality. COMEX has 34.2 million ounces of registered silver available for delivery. That gap is not tight. It's not uncomfortable. It's catastrophic. And it gets worse. The February 2026 futures contract alone shows approximately 67,000 open contracts. Each contract represents 5,000 ounces. That equals 335 million ounces of notional silver tied to a single delivery month. 335 million ounces against 34.2 million ounces of registered inventory. Do the math. Slowly, carefully. Even before March 31st, delivery obligations already exceed available metal by 160%. That's not a shortage. That's a structural failure. The system is promising far more silver than it can physically deliver, even if every single bar were handed over. This is where the illusion breaks. COMEX does not operate on a one-to-one system. It operates on a fractional reserve model, just like the banking system. When you deposit money, the bank does not keep it all. They keep a fraction and lend the rest, assuming not everyone will withdraw at once. COMEX does the same thing with silver. They issue contracts for metal they do not fully possess, assuming most participants will settle in cash instead of asking for delivery. For decades, that assumption held. Fewer than 3% of contracts ever stood for delivery. The system survived because pressure never arrived all at once, but assumptions are fragile. What happens when delivery demand jumps to 15%? What happens at 30%, especially when the contracts are held not by short-term traders, but by sovereign wealth funds, central banks, and industrial users who actually need the metal? At that point, this stops being a squeeze. A squeeze implies pressure that can ease. This cannot ease. You cannot deliver what does not exist. You cannot print silver. You cannot negotiate with physics. When promises exceed reality, something breaks. The banks understand this. That's why they're scrambling. That's why they're paying any price. That's why time suddenly matters. Because once enough people ask for metal at the same time, the question won't be how high prices go. It will be who gets delivery and who doesn't. When systems like this come under pressure, there is supposed to be a release valve, a backup, a safety mechanism that keeps everything from snapping at once. For silver, that mechanism was always arbitrage. For decades, when COMEX ran short, metal could be pulled from London. Paper claims in New York could be quietly converted into physical silver stored overseas. This invisible bridge kept the market functioning. It smoothed stress. It hid shortages. It saved the system again and again, until it didn't. In the fourth quarter of 2025, the London Bullion Market Association reported a net outflow of 127 million ounces of silver. That wasn't routine movement. That wasn't rebalancing. That was the largest quarterly drawdown in the LBMA's 117-year history. Asian refiners were pulling metal out. Middle Eastern sovereign wealth funds were withdrawing silver directly. And critically, much of this metal was leaving without passing through traditional COMEX settlement channels. The pool that used to refill shortages was being drained from multiple directions at once. This is where frustration turns into clarity. For years, the market relied on exchange for physical transactions, or EFPs. When COMEX couldn't deliver locally, it swapped paper exposure for London metal. The cost of that swap was trivial, 2 to 3 cents per ounce, a rounding error, a sign that everything was functioning. Then came November 2025. EFP spreads exploded to $1.47 per ounce. Not a glitch, not volatility, a signal. That spread didn't widen because demand surged. It widened because there was no metal left to arbitrage. The bridge itself was collapsing. When arbitrage stops working, price signals break. And when price signals break, markets stop being markets. This is the part they never explain on television. Arbitrage isn't optional. It's the glue. Once it fails, shortages stop being regional and become global. There is no hidden stash to pull from. No quiet workaround. No overnight fix. COMEX didn't just lose inventory. It lost its escape route. The banks understood this immediately. That's why they didn't wait. That's why they didn't negotiate. That's why they started pulling metal directly, even at extreme cost. Because when arbitrage collapses, the system doesn't bend, it snaps, and once that bridge is gone, the next stress point becomes unavoidable. What happens when there is nowhere left to source silver from at any price? Once the arbitrage bridge collapsed, the situation stopped being theoretical. This is where the banks themselves became the problem. JP Morgan, HSBC, and Bank of America weren't just observers. They weren't traders looking for profit. They were institutions with delivery obligations contracts that required them to provide physical silver to clients who were legally entitled to receive it. And now, the metal wasn't there. Between November 15th and December 20th, verified London Vault records showed these three banks pulled a combined 40 million ounces of silver out of London storage. Not gradually, not opportunistically, aggressively. This wasn't portfolio management. This was damage control. Because when clients with size demand delivery, excuses don't work. These banks weren't buying silver because they wanted to. They were buying because they had to. Behind closed doors, the math was brutal. Delivery schedules were approaching, inventory was shrinking, arbitrage was gone, and the penalties for failure were enormous. Not just financial penalties, but reputational ones. In the derivatives world, credibility is currency. Lose it once, and counterparties disappear. So they did the only thing left. They paid whatever the market demanded. In just 6 weeks, these institutions spent over $3.4 billion acquiring physical silver in what became the most aggressive accumulation campaign in modern precious metals history. And even after all that, after draining London, after paying premium prices, after accepting delays, the numbers still didn't add up. That's the part nobody wants to talk about. COMEX registered inventory sat at 34.2 million ounces. Add the 46.4 million ounces these banks managed to secure, and you reach 81.6 million ounces. But delivery obligations for the next 3 months alone exceeded 89 million ounces. Even after spending billions, they were still short. This is where panic logic takes over. When there is no path back to balance, choices disappear, strategy collapses into survival. And suddenly, there are only two options left. Buy more metal and push prices even higher, or fail to deliver. There is no third option, no clever workaround, no regulatory magic that creates silver out of thin air. Fractional systems work only until they don't. And once confidence cracks, everything accelerates. The banks understood this before the public ever saw the numbers. That's why they moved first. That's why they moved fast. And that's why price suddenly stopped mattering. Because when delivery risk replaces price risk, the question is no longer how expensive silver becomes. It's how exposed you are when the system finally admits it can't deliver. While Western banks were scrambling to secure metal at any price, a far larger force had already moved, quietly, methodically, and with intent. On November 8th, 2025, China did something it had not done since 2009. It disclosed its true silver reserves. The State Administration of Foreign Exchange released a transparency report showing 23,000 metric tons of silver held in national reserves. That equals 739 million ounces, more than the entire annual global mine supply. For 16 years, China officially reported zero silver holdings. Analysts assumed the metal had been sold off during the 2011 spike. That assumption was wrong. China wasn't selling. It was accumulating, in silence, across cycles, through every dip, without drawing attention. And the timing of that disclosure was not accidental. Just 3 days later, China's Ministry of Commerce issued Emergency Order 2025-47 banning all silver exports immediately. No tariffs, no quotas, because the full stop. If you were a foreign buyer relying on Chinese silver, access ended overnight. This is where the story shifts from financial stress to geopolitical strategy. China controls approximately 18% of global silver mine production. That metal used to flow into international markets. Now it doesn't. It stays inside China, supporting domestic industry while the rest of the world competes for what's left. We've seen this playbook before. In 2010, China restricted rare earth exports during the Senkaku Islands dispute with Japan. Prices exploded, supply chains broke, entire industries were forced to reorganize. That wasn't a trade dispute, it was leverage. This is the same move, just with silver. Ask yourself the obvious question. Why reveal reserves now? Why ban exports now? China could have continued accumulating quietly for another decade, buying Western supply at suppressed prices. Instead, it chose visibility, it chose confrontation, because this wasn't about secrecy anymore. It was about signaling, we have the metal, you don't, and we're not sharing. That message lands differently when global inventories are collapsing, arbitrage is broken, and banks are already trapped. it turns a supply shortage into a strategic weapon. This isn't market behavior, it's resource warfare. And once nation states start treating silver as leverage instead of a commodity, the crisis stops being cyclical, it becomes structural, which raises the next uncomfortable question. What happens when industrial demand collides with geopolitical control and nobody has enough metal left to meet both? Once silver became a geopolitical weapon, the pressure didn't stop at borders, it moved straight into the real economy. This is where the story stops being about banks and governments and starts colliding with industry itself. On December 12th, 2025, Tesla, First Solar, and 13 other major solar manufacturers sent a joint letter to the U.S. Department of Energy. The warning was blunt. Silver shortages were threatening production timelines. Installations could be delayed. Projects could be halted. This wasn't posturing. Solar panels require silver for electrical conductivity, about 0.55 ounces per panel with current technology. At 20 dollars per ounce, silver accounted for roughly 3% of total panel costs, manageable. At $72 per ounce, that figure jumps to nearly 8%, margins collapse. Economics break. Publicly, the message was concern. Privately, the behavior told a different story. Just days later, those same companies locked in supply. On December 15th, Tesla secured 8.4 million ounces of silver at $71 per ounce, with deliveries scheduled through 2028. On December 18th, First Solar locked in 12.7 million ounces at $73.50 per ounce. This is the paradox that exposes the truth. If prices were too high, they would stop buying. They didn't. They accelerated. They committed years forward because procurement teams don't care about narratives. They care about continuity. And they were staring at the same reality as the banks. $72 wasn't the ceiling. It was the floor. This is what real demand looks like. Not speculation, not leverage, necessity. You can't build electric vehicles or solar panels without silver. You either secure it now or you gamble that it will exist later. At the same time, the most conservative institutions on earth were reaching the same conclusion. On December 3rd, 2025, the Bank for International Settlements quietly changed the rules. Silver was reclassified as a Tier 1 asset under Basel III reserve regulations. For the first time since 1973, silver was no longer treated purely as an industrial commodity. It was money again. And central banks responded immediately. The Swiss National Bank purchased 187 metric tons of silver in the third quarter of 2025. The Monetary Authority of Singapore added 243 tons in October and November. The Saudi Arabian Monetary Authority purchased 460 tons between September and December. According to IMF data released on December 15th, these institutions don't chase trends. They position for transitions. This is demand that does not liquidate. It does not panic sell. It does not disappear. When industry must buy to survive, and central banks buy to anchor their balance sheets, demand stops being cyclical. It becomes structural. And that leaves one final question. What happens to price when permanent demand collides with a market that's already running out of metal? Strip away the noise and the story becomes brutally simple. The silver market is running a 265 million ounce annual deficit every year. That gap doesn't close with optimism or policy. It closes only through price. And the math says the market doesn't balance until silver trades somewhere between $150 and $2 per ounce. But markets don't move smoothly when systems break. They snap. The clock is already running. January 15th, 2026 is first notice day. That's when holders of February contracts can demand metal. February 28th is the delivery deadline. That's when promises meet reality. And March 31st, Basel III's net stable funding ratio forces European banks to choose paper exposure or physical assets. Those dates aren't forecasts. They're obligations. When COMEX can't deliver, price discovery doesn't politely adjust. It relocates from paper screens to physical markets. And physical markets with less than a month of global inventory don't negotiate. They ration. That's how you get $200 silver. So that's how you get $300 silver. That's how panic pushes prices toward $500 per ounce. Not because silver magically changed, but because the system that priced it finally failed. The banks already understand this. That's why they're buying now. Governments understand it. Industry understands it. Central banks understand it. They're positioning quietly, not arguing loudly, because by the time everyone agrees, There's nothing left to debate. This moment isn't about predicting the future, it's about recognizing the present. A system built on trust only works until trust demands proof. And when that proof is measured in ounces instead of promises, there are only two kinds of people left: those who saw it early and those who asked what happened after the crowd arrived.